If you have been investing in the stock market, you probably heard of many fancy methods to evaluate stocks. One of the most common metrics that people always use is called the PE ratio. From ordinary retail investors like us all the way to sophisticated investors like Warren Buffett, they all will use this common measure one way or another. For example, someone will come to you and say if a stock PE ratio is lower than 10 times, that's cheap and buy. If it's more than that, forget about it. It's almost like a magic number, a holy grail that people use to measure the stock whether it can go up or down. The question is, if everybody is using PE ratio so much, it should be super easy to invest and everyone should make money from the stock market. But why when fund managers use it or when professional investors use it, they make money, and when you use it, a lot of times you end up losing money? What are you missing out? Now, let's start with the basics. For some of you might even ask, what is PE ratio? Is it some kind of rocket science that predicts the share price? The PE ratio, or price to earnings ratio, is a financial calculation that measures a company's valuation by comparing the company's share price to its earnings per share. In essence, the PE ratio is like a price tag on the company's profits. It tells you how much money people are willing to spend to buy $1 of that company's earnings. Think about it this way. If you go to the supermarket and you see 2 packets of 3-in-1 coffee, one of them has 15 sachets selling for 15 ringgit, while the other one has 12 sachets selling for 14 ringgit. Which one is cheaper? On the surface, the 14 ringgit packet definitely looks cheaper. But when you compare the number of sachets inside both packets, suddenly you realize buying the 15 ringgit pack is more worth it because you get more value for each sachet they give. So, relating this back to stock valuation, if a company has a PE ratio of 10 times, it means investors are willing to pay $10 for every dollar in earnings that the company makes. It's a way to see if a company's stock is a good deal or too expensive. As you can see, PE ratio is a quick and easy way to give you a sense of whether a stock might be cheap or expensive. If the PE ratio is low, it could mean that you are getting a bargain. But the problem of using PE ratio that way is that it is too simplistic. I wish investment could be that easy, but unfortunately, there are 3 things we need to consider, and I'm going to explain them in detail as we continue to talk about it. First, the PE ratio is pretty straightforward. It's just the stock's price divided by the company's earnings per share. Usually, investors fall into the valuation trap when they use this formula bulat-bulat and ignore how these companies actually earn their profits. This is especially true when the company knows their investors like to use PE ratio as their primary measurements of their stock valuation. You see, some companies have mastered the art of earnings manipulation. But I'm not saying that they report fake earnings or something like that. They use accounting techniques that might temporarily boost their earnings and give you the illusion that their PE ratio is more attractive. For example, they might shift some of the expenses to a later quarter so that you don't see them today. Or they may recognize revenue too soon to show you great profit and make you feel that you are missing out for not jumping into the bandwagon. There are also instances when a company recorded some extraordinary items like reporting a one-off gain from selling off an old factory. All these will create the illusion that the PE ratio is low. If your investment is solely guided by PE ratio, there's a chance that you may fall into this valuation trap and wonder later why your investment is losing money when you bought a stock when the PE ratio is low. Secondly, assuming you have done your homework knowing the company upholds the utmost integrity when it prepares its financial statements, and you still find their PE ratio is low, that's great, right? It feels like you have discovered a gem. Well, be careful. There's a saying that goes, things are cheap for a reason. Just like the 3-in-1 coffee example earlier, whether it is 15 ringgit or 14 ringgit for a pack of coffee, we know that one sachet of coffee costs between 1 ringgit to 120. That's so-called the fair value of the coffee. But if you suddenly find another brand where per sachet costs only 20 cents, is that really a bargain? Maybe it is, but maybe also because the manufacturer uses lousy raw materials to make the coffee, and it probably tastes bad. Over time, fewer people would buy that coffee even though it is cheap, and eventually it may just be taken off the shelf. The point here is that when you discover a stock where the PE ratio is too much lower than similar companies operating in the same industry, perhaps you miss out very important information that the market is already reacting to. Take some time to deep dive further to see if you could find out what that missing puzzle is. Talk to other investors, text your reminders once you are confident that you get all the information covered. Congratulations, you really found a gem. Thirdly, if you haven't noticed by now, when I use the example of 3-in-1 coffee in a supermarket to explain the PE ratio, I only talk about coffee and not milk powder or anything else. This is because milk powder is an entirely different product where the ingredients are different, the nutrition value is different, and therefore the price is usually a lot higher compared to coffee. It's just unfair to say that a 50 ringgit milk powder is expensive and a 50 ringgit coffee is cheap. In the context of stock investing, one big mistake that investors always make is to use PE ratio to compare everything in the stock market, from properties to tech stocks to banks and whatever that you can think of. When you do that, the result can be very misleading. You see, each industry has its own characteristics, and it is important to understand how each industry makes money in their respective businesses. For example, tech stocks usually trade at a very high PE ratio. This is because, according to Moore's law, the number of transistors in an integrated circuit doubles every 2 years. So, if all else being equal, a tech company should double their profit every 2 years. With that assumption in mind, investors are willing to pay a much higher premium on tech stocks for the high growth potential in them. On the other hand, say a bank. It makes money by lending money to people and collects an interest over a very long period of time. It is very hard to gauge the amount of profit a bank can generate if we simply just use the PE ratio, because it only gives you a snapshot of the bank's earnings at the time frame that you are using it. Ultimately, you would want to know how the bank can continuously lend out more money to people to sustain the interest income in the long run. If you're interested to find out more about how a bank works, check out this video over here. In order to use the PE ratio effectively, you must remember to compare apple to apple. So the next time somebody tells you a particular stock is cheap, trading at 10 times, 15 times PE ratio, search for other similar stocks and compare if the recommendation makes sense. Now, it is clear that PE ratio is more than just a mathematical formula. You need to have a deep understanding of what you are using it for in your stock analysis. It's not about simplifying the process or relying on magic numbers. It's about delving into the details, asking the right questions, and diving deeper into the business that your stocks are involved in. Once you truly grasp the nuances of the PE ratio and its usefulness, you might even make more money than professional fund managers. After all, investment literacy is the secret sauce that separates good investors from great ones. If you watched this video to this point, thank you for joining us on this journey. Give me a thumbs up emoji in the comments if you like this kind of content, and I will talk more about other metrics that you can use to invest in my future videos.